So we're going to talk about risk protection today. Uninsured losses, of course, crossed $100 billion last year, according to Swiss Re. Rather, insured losses, and uninsured losses were maybe a multiple of that amount. And total spending on insurance premiums, extreme weather, and resilient infrastructure crossed 13 trillion over the past 12 years, according to Bloomberg Intelligence. The sense I get is that we're at a critical juncture for the insurance industry with AI and with the explosion of data from satellites, geospatial data, e-commerce, all of that, that can really help you build models that link natural disasters to outcomes, including macroeconomic outcomes. But I'm very excited to be talking to you today, Jennifer and Benedikt, about this and what this means, what AI means as well, data analytics for the insurance industry and reducing that protection gap in Asia today. Maybe I'll start with you, Jennifer, and talking about the protection gap. Climate-related losses are growing, but an increasing amount or number of properties and land in the region are becoming uninsurable, or slowly, going forward in the next few years, it will become. Where do you see the biggest pockets of vulnerability and where insurance is going to potentially be withdrawn?
Yeah, thank you. And thank you so much for having us here today. Just in terms of the protection gap, I think I'll reiterate what you said. Asia has the largest protection gap in the world, where we see a protection gap of around 90% as compared to 70% in the United States, 50% in EMEA. So it's clear that we have a gap, I think, in understanding around what the true cost is of some of these climate-related events, which, as you say, are leading to perceptions around uninsurability. And I think really at the heart of all of this, going to your point about big data sets and data and analytics, what's absolutely critical to this is that better data and insights are available to both companies, government entities, so that people truly understand what the cost is of these events. That will allow people to understand the true return on adaptation measures as well as resilience. I think, Ishika, you spoke about earlier how you're starting to see private equity firms and others really building into their due diligence what the cost is of climate-related issues. And I think that's the starting point, right? Right now, we actually don't have a true understanding of what the cost is of these physical climate risks. And I think that's where it starts, right, is we really have to understand that better. The insurance industry has actually been solving for this for a long period of time, right, taking data to help solve uncertainty. And one of the things that we've been really focused on is to bring to bear some large data sets that we've always had available for our large insurance clients to essentially democratize that data, to bring it to our corporate clients as well as to governments and other entities so that they can truly understand, claims trends, actual data, asset-specific data around what the cost is. And so I think that's really the first part. The question around uninsurability and sort of stranded assets, I suppose, is really it's a good one. But I think it's one that we need to challenge ourselves to solve, right? Because that's just a question about whether insurance capital is attracted to insure something at a commercial rate in which someone wants to actually transfer that risk. Really, what the question is how that we build in better resilience to attract capital to these events. And we are starting to see more innovation there. One of the things we'll talk about, I'm sure, today is around things like parametric insurance, right, where you're able to understand with a more simple trigger what, attract capital through better data and analytics to help make things that otherwise may not have been insurable, and to bring back in stranded assets into a commercial frame.
Yeah, and we will come back to that in the conversation. But you kind of skirted my question there. But I wonder if you have any particular sectors or countries that you're most worried about at this point in terms of providing insurance to from climate-related losses.
Yeah, and just to be clear, we arrange capital to support our clients and to support transactions. We don't actually take risk, and so we have a really good view on where we're trying to see pricing increases or assets that become uninsurable. And certainly the trend is climate exposed areas are certainly seeing higher volatility in pricing, more need for better data. And there's certainly pockets in Southeast Asia, parts of India, where we see extreme, I spent the last 14 years in Australia. There are aspects in Australia where government has had to come into bear around things like cyclone pools to help solve some of these questions. And Benedikt, I think, exactly some of the great work that you're doing around this as well.
Yeah, coming to Southeast Asia in particular, and the countries here don't really have the fiscal headroom. So for spending a lot on disaster resilience. So where are you seeing the most vulnerable pockets again to you? And how are you seeing any change in flows from the private capital space for insuring these parts?
Thanks, Ishika. Maybe just to set the scene slightly, we're ever slightly less well-known than Aon at this point, catching up hopefully soon. So SEADRIF is a Singapore general insurance company set up and owned by ASEAN +3 finance ministers, specifically to address that growing protection gap. And the way we are looking at this is we act as a market maker, right? We talk about the protection gap. The question is, why does it exist? And so if I look at this, it's not that the private capital doesn't exist or the expertise doesn't exist. The insurance market had history of 200, 300 years. It's been around for a long time.
And in fact, there's never been more insurance capital available than there is today.
Exactly.
It's just finding different places.
If we look at this from the public sector, and that's where I would say, Ishika, your question, where is the real need and an unaddressed need? It's actually a lot of what's public liability, which then flows through to a fiscal problem. But I see a market failure. Its demand is increasing, political awareness is increasing, including in Singapore, very much so across the region. Private expertise capital is there, but the market is not closing. So the question is, how can we bridge that market failure to start addressing the protection gap? And I see three main barriers. It's a question of price, it's a question of products, it's a question of trust. I'm sure we'll unpack some of those more.
Are you seeing insurability improve in any part of the region?
I think to improve insurability, we need to address some of those barriers, right? How can we make products fit for purpose? How can we achieve a price that is justifiable on the public side and actuarially commercially sustainable on the private side? And how can we build origination channels, go to market that actually make it possible and feasible? I absolutely do think that these points are changing. I'm sure we go deeper into those. Across the region, the governments we're working very closely with the Philippines, with Indonesia, with Laos, where we started, across the region. There's a real shift change where the ministries of finance step up and say, this is not a civil protection problem, this is a fiscal problem, fundamentally a fiscal problem where the government has to take a role and do something different about this, because it's not only about disaster response, it's about attracting investment, it's about protecting supply chains, it's about protecting economic growth, human capital for the long term. So I think it's absolutely going in the right direction. We have a long way to go by getting the mechanisms right, the nuts and bolts right.
I think I'd reiterate that just around where we're seeing clients be able to attract capital to support their needs. The one trend I would say there, it's around the sophistication of the data sets to really help the insurance capital understand what the risk is that they're being asked to assume and to be a partner in modeling an outcome that is sustainable for the insurance capital, but also meets the need of the client. And frankly, an element of that that's required is scale, which is why some of these public to private partnerships are really relevant, as well as where we see the most success would be some of our really large clients who can take a view across multiple asset pools, multiple locations. And I think you spoke before about private equity, also able to take a portfolio view across some of these matters as well. But scale, I think, is also a real critical element of it.
What types of products are you seeing the most demand for from governments, from companies in the region? What are they willing to spend the most on and would be the biggest growth driver for your businesses in the next 5 years?
Well, certainly from my perspective, the traditional product, sort of the hero product of property insurance is absolutely critical. I think it goes without saying that that is the bedrock of the protection. And when people talk about things like parametrics, which for people in the audience who don't deal with insurance every day, it's essentially assurance that's designed around simplified trigger. And it's more of a binary response around it pays or it doesn't pay when a trigger is met. And it has a very fast recovery speed and a simplified claims process. So people talk a lot about parametric insurance, and my observation on that is that it is typically used in support of traditional insurance or traditional approaches to insurance around an area where there's either a real need because of the catastrophic impact of a particular trigger, or because there is more efficient pricing to be had through a simplified trigger. But I think, certainly that's getting a lot of attention, but I think I want to stress that it normally is in support of more traditional insurance arrangements.
I think it's slightly different in the public sector, where there's a lot more, and for us, definitely our work is primarily starting with parametric insurance. But that's also because it's often easier to understand and easier to set up, right? Mm-hmm. When we talk about protection gap, what I always find interesting is that very often when we talk about protection gap, the conclusion is, well, people writ large just don't know that they need insurance. We need to educate them better. Mm-hmm. I'd say most industries, if nobody's buying your product, you look at improving your product, you look at changing your distribution channels. Mm-hmm. I think in the insurance industry, we have to be honest about, are we actually offering something that's easy, that's fit for purpose, that whether it's public sector or private sector can adopt and can roll out and but actually use for the risk management. Mm-hmm. So the way I look at this for SEADRIF, this is exactly our mandate, right? We have a balance sheet, limited balance sheet, but to be in between public and private. And when we design a new product with a member government, we co-create it to be fit for purpose. We take it to insurance markets. And insurance markets say on day one, that's perfect, great, oversubscribed, take a market. I feel we haven't pushed hard enough. Yeah. We expect in the public sector to come out of their comfort zone to learn insurance language, learn insurance products. Mm-hmm. I feel insurance markets also need to come out of their comfort zone. We need to find the middle ground. Yeah. And very often that's what advanced developed markets have done around the world. We talked about this earlier in Australia, in the UK with flood re, in New Zealand, Natural Hazard Commission, in the US, in Florida, in California, earthquake. Everywhere there's in-betweens, there's translators, there's public pools of capital that take on some risk, either because it's too risky, it's a price question, we can talk about this separately, to help de-risk the cost, but also to help distribution, to help build trust, to be an in-between that unlocks the private capital on the other side. That's exactly what we're building for Southeast Asia.
There has been an increase in parametric activity, as you said, right? Even for glacial melt in Central Asian countries, I think that was structured recently. But what was interesting to me to see was Singapore earlier this month come out with a public consultation on captive insurance, right? And making it more attractive to have companies set up captive insurance. Do you think that's an alternative that businesses would consider in terms of retaining risk?
I think it's absolutely, it's absolutely fantastic, right? So that the arrangement essentially allows smaller to mid-sized corporates to essentially access captive structures in a rent-a-captive approach, which Singapore has set up. And I think it's really critical and wonderful to see the support there. But what I would say is that it doesn't solve anything if you don't have the right data to understand what risk you're looking to treat and what the pricing is of that risk. And so I think that frequently it can be viewed as sort of a panacea. Oh, we're going to get access to another lick of, another huge lick of capital. We're going to access the ILS markets. And this is sort of the utopian response to an affordability crisis. And I don't think it's that. I think it's another avenue to access capital, but it will not solve issues around understanding what the true price is of physical climate risk, and what the trade-offs are around adaptation and resilience as well, because there's no pools of sort of dumb capital out there, so to speak.
Just quickly on this, there's actually 3 use cases that MAS has published around this, and the third one is sovereign risk pools. I think we are probably the only one in Singapore at the moment, so we have quite a strong interest in this. What it helps us, and we have been waiting for this actually to come to fruition, or still waiting to come to fruition, is it helps you to segregate assets and liabilities, right? What the PCC, the Protected Cell Company, does. It helps you segregate liabilities so you can set up the rent-a-captive, you can bring in outside capital liabilities. For us, it also helps us segregate different public liabilities. So some funders may want to protect agriculture specifically, and we're looking at setting up a regional agriculture reinsurance facility and a market infrastructure facility that could be segregated in its own cell. Likewise, we're working with development banks to embed insurance into new infrastructure investments. This could be segregated into protected cells that come either because the funding comes from a specific partner or the liability, the risk belongs to a specific asset class. So that makes it much easier to stand up these solutions instead of right now we'd have to set up an SPV or we'd have to create a new subsidiary company. Right. And likewise in your case with ILS, with cat bonds, it streamlines a lot of this. It makes it more attractive and easier to experiment, to offer bespoke custom solutions.
Absolutely.
Okay, I wanted to come to data analytics because that's something very interesting to both of you and a lot of people in this room, I'm sure. Can you give us a look under the hood and tell us what is the new type of data that you're actually using now when you're pricing policies, and what are kind of the new models and now the new challenges that are coming up, because maybe there's just too much data out there and that could muddy your assumptions and estimates.
I think fundamentally, and this wouldn't be a discussion in 2026 without a reference to AI, what we're seeing is that we've always had various models, which, various types of CAP models and sophisticated approaches to understanding data. But what big data sets and AI enable us to do is to work through the data much more quickly with larger data sets to help our clients see around corners and to draw insights over what were probably in the past uncorrelated data sets. And so just by way of example, we can look at things like not just the property impact from a given climate event, but also what the health-related impacts could be on a population through workers' compensation impacts, health insurance. And so it allows us to put together larger data sets to draw insights for our clients, which enable them to make more profound decisions around data sets that in the past we weren't able to connect. And so I think there's a speed piece, there's a quality of insights, but it does come down to your question around the data, and something that we're incredibly focused on as a firm, right, is in terms of establishing those data lakes, and creating the right level of governance and understanding of where we want to pull the data. And I think also as we, in the past, we've served a lot of our large insurance clients with very large, complex sets of data. Now we're trying to democratize the data and get it into models that are more understandable for a wider a set of the population, so that the speed and the accuracy can be there, which can allow us to have a much more profound impact across larger parts of the economy. And so I think that piece is incredibly important and really exciting about what AI is enabling us to do.
Benedikt, what new types of data sets are you using now?
So we're very small. We are a user of the innovation that comes out of the behemoths like Aon. But 2 things to add. So one is we did develop our own insurance product with a very different data set, actually very simple, dumb data, not big data. We're triggering insurance product against the number of people affected by disasters as reported by the government. reports, creates all other questions that the insurance industry had around this, what I said earlier, pushing everyone out of their comfort zone. But what it means, it's the data the government already uses for their decision making. It's not something new, it's not a black box, it's the data they have. And so for us, what we see very often as challenges, we need that big data, that innovation, the CAT models for the pricing, for the product development. But we also need to translate this to decision-relevant information that somebody's comfortable standing and saying, I understand this and I can put money on the line for this. If you're in the public sector and you say, I have to make a decision between investing in schools today or protection tomorrow, that's a very hard trade-off to make and to publicly justify. Or in a business, do you invest in CapEx or do you buy insurance or do you buy future protection? It's a very hard trade-off to make. And if you don't have the right decision or information, we're not going anywhere. So in SEADRIF, we actually developed one of our principles is keep it simple, SEADRIF. Focused on everything we do has to simplify complexity for our clients. If it adds complexity, it's not going anywhere. And we know there will not be any uptake.
I mean, in addition to simplification, some of the private equity funds I was talking to were saying that they're engaging insurers on the idea of avoided losses.
100%.
Whether this forward-looking data, whether the forecasting data sets can actually help with pricing, changes to pricing today for a business that's agreeing to take up insurance to safeguard itself against a natural disaster, right? But it seems like it's still early stages. Can you walk us through how you're thinking about changing the incentives for someone to buy insurance?
Yeah, absolutely. I mean, I think that's the risk-reward trade-off, right? And where, as Benedikt said before, what our role is as an intermediary is to really push the insurer partners out of their comfort zones around making sure that the right reward is there for clients who do invest in resilience. And so there are certainly, and I think the key there is a multi-year plan that is presentable and quantifiable in order to create the tangible result for the insurance capitals in order to value it and give you the reward. But I think you're, the carrot and the stick, right? We feel enough stick, but we got to get the carrot. We've got to get the carrot working.
Just last word on this. I think it's just, since we're both from the insurance industry in different constellations, it's very important, I think, for us to emphasize to everyone else that insurance will not solve the problem. Insurance is one piece to help build resilience, but fundamentally everyone has to invest in resilience, has to invest in risk reduction, and then insurance can help you manage that residual risk. But of course, importantly, it can help you drive resilience through all business decisions beforehand. It's a pricing tool. It puts a price on risk. It makes risk visible. It puts an ownership on risk. But it has to be used to drive resilience into everything else you're doing. So fully agree with that.
Just one last thought. I know we're up on time, but
we're going to get rolled off the stage soon.
In terms of pricing chronic climate stresses, right, like extreme heat or environmental stresses like pollution, I spoke to a few insurers. There's still not enough frameworks in place for them to be able to quantify that and change the pricing or think of policies with regard to chronic risks, right? How far away are we from being able to quantify that and actually for it to start impacting premiums in countries such as India?
I think it's impacting premiums right now because we're seeing the losses come through in terms of some of these major events, right? We had a study in Australia that showed the impact on well-being and mental health claims due to the extreme fire events. And so I think it would be very naive to assume that those costs aren't currently coming through the system. We're seeing medical inflation in Asia plus 11%. Singapore, where we sit right now, is 16%. Right? So the spike that we're seeing in medical inflation costs are certainly coming through in some of these extreme weather events, loss of productivity, workers' comp claims. In terms of being able to quantify it on a standalone basis, I think certainly there's more of a challenge there. The other thing I would cite, though, is that only 60% of organizations are actually building well-being and workforce support programs in around weather-related events. So there's an opportunity there for all employers, frankly, to be turning their minds to how they support reduction efforts vis-a-vis weather-related events.
Very short last word on this.
Yeah.
I think as Jennifer said, rightly said, we are paying anyway for risk, for climate risk, they materialize. We're already paying. So better risk protection and insurance does not mean spending more, it just means spending smarter. Thinking upfront about this, where the money comes from, how it flows, how you can reduce risk. and over time build that resilience.
Yeah, so assess your risks and take the necessary precautions after that. I think that's a good note to end on. We've run out of time. Please thank me. Please join me in thanking Jennifer and Benedikt.
Thank you, Ishika.
Thank you so much.